In the early 1990s, the United States stood at the threshold of what would become one of the greatest financial disasters in modern history, yet almost no one recognized it at the time. It began with a simple, optimistic idea. Every American should be able to own a home. Politicians embraced it, banks celebrated it, and families believed it. Homeownership wasn't just a financial decision. It became a patriotic dream, a symbol of success, stability, and the American way of life. But behind this inspiring narrative, a dangerous machine was already warming up. For decades, the housing market grew steadily and predictably. Banks followed strict lending standards. Buyers needed solid credit scores, documented income, and real down payments. Mortgages were boring, safe, and built on common sense. But starting in the mid-1990s, everything changed. The U.S. government began pushing aggressively for expanded homeownership, especially for lower-income Americans. Agencies like Fannie Mae and Freddie Mac loosened their guidelines, and political pressure mounted on banks to offer more mortgages to more people, regardless of financial background. At the same time, Wall Street discovered something powerful. Housing loans could be turned into a money-printing machine. The more mortgages banks issued, the more financial institutions could package and sell them as securities. For the first time, the housing market wasn't just about homes. It was about profit. This new alignment of political goals, corporate incentives, and public enthusiasm created a perfect storm. Banks realized that they didn't need borrowers to be safe or stable. They only needed them to sign the paper. Because once a mortgage was issued, it was quickly sold on to other institutions. The original lender no longer carried the risk. That risk was now sliced, bundled, and shipped across the global financial system. And so began the era of reckless optimism. Mortgage brokers, once cautious gatekeepers, became aggressive salespeople chasing commissions. They were trained to push loans onto anyone who walked through the door. It didn't matter if the borrower had low income, unstable employment, or even no documentation at all. The new logic was simple. The housing market always goes up, so what could possibly go wrong? The American public embraced the frenzy. Families who had never imagined owning a house were suddenly approved for mortgages. People who already had homes bought second and third properties as investments. This wasn't just a financial shift, it was a cultural transformation. Housing became the ultimate asset, a guaranteed path to wealth, the one investment everyone believed could only rise in value. But beneath the optimism, cracks were already forming. Lending standards collapsed. Risky loans became the norm. The entire system began relying on an illusion, the belief that home prices could never fall nationwide. It was a myth accepted by politicians, banks, investors, and homeowners alike. And once a myth becomes the foundation of a multi-trillion-dollar market, it's only a matter of time before reality tears it apart. The birth of America's mortgage fever wasn't an accident. It was engineered. It was encouraged. It was celebrated. And it was built on assumptions so fragile that the entire structure was doomed to collapse from the moment it began. By the early 2000s, the United States had entered a financial environment that practically guaranteed reckless behavior. The Federal Reserve, in an attempt to stimulate the economy after the dot-com crash and the shock of 9/11, pushed interest rates to historically low levels. Borrowing money became cheaper than ever before. And in a world hungry for growth, cheap money is like pouring gasoline on dry wood. It ignites everything around it. For banks and lenders, the message was clear: lend, lend, and lend more. The lower the interest rate, the more mortgages they could issue, and the more mortgages they issued, the more profit they could generate by selling them to Wall Street. Suddenly, mortgage lending was no longer a cautious, conservative business. It became a factory, fast, aggressive, and shockingly profitable. But the real transformation came from a cultural shift that spread across the country. The belief that owning a home was not just desirable, it was a right. Politicians promoted it. Media romanticized it. Banks weaponized it. Homeownership was sold as the ultimate sign of success, a guaranteed investment, and the foundation of the American dream. The narrative was seductive, and millions bought into it. This dream, however, demanded fuel. And that fuel was borrowers, millions of them. Banks realized that if they evaluated customers too strictly, the growth would slow down. So they stopped evaluating them. The industry abandoned standards that had defined lending for generations. Income verification became optional. Down payments became unnecessary. Credit history stopped being a barrier. Lenders even introduced ninja loans. No income, no job, no assets. A product that would have been unthinkable just a decade earlier. The logic behind this insanity was disturbingly simple. As long as home prices keep rising, nobody loses. Even if a borrower defaulted, the house would be worth more than the original loan. Banks convinced themselves that the market was self-correcting, and they convinced everyday Americans of the same. Mortgage brokers, now paid by commission rather than loan quality, became sales machines. They knocked on doors, ran ads, cold-called families, and targeted the most vulnerable groups. The goal wasn't to find qualified borrowers. It was to find any borrowers. Because every signature was another asset they could sell to Wall Street. And Americans, overwhelmed by the allure of easy money, followed along. People began treating homes not as places to live, but as wealth-generating assets. Ordinary families took on mortgages they couldn't afford because they believed their homes would double in value. Investors bought multiple properties, expecting endless appreciation. The housing market had become a national obsession, a casino where everyone thought they would win. But underneath the excitement was a ticking bomb. Millions of borrowers were entering long-term contracts they had no capacity to honor. Lenders were stacking risk on top of risk, confident the rising market would cover the damage. And the entire system became dependent on one catastrophic assumption, that the price of a home could only go up. The cult of homeownership, fueled by cheap money, aggressive lending, and national pride, created a perfect recipe for disaster. Banks weren't just lending recklessly, they were reshaping the American financial landscape around a delusion. And once this delusion became the foundation for trillions of dollars in mortgages, the outcome was inevitable. If the reckless lending of the early 2000s was the spark, then securitization was the gasoline that transformed a risky market into a global catastrophe. At its core, securitization was a financial trick, a clever mechanism Wall Street used to turn millions of unstable mortgages into sophisticated investment products that looked safe, profitable, and irresistible. But behind the polished surface was a toxic core waiting to explode. Traditionally, when a bank issued a mortgage, it held the loan on its own books. If the borrower failed to pay, the bank suffered the loss. That system encouraged discipline. It forced lenders to verify income, assess risk, and issue loans responsibly. But with the rise of securitization, that centuries-old model vanished overnight. Here's how the game worked. A bank issued a mortgage, any mortgage, good or bad. Then, instead of waiting 30 years to be repaid, the bank immediately sold that mortgage to a financial institution. That institution bundled thousands of loans together into massive pools. These pools were then divided into pieces called tranches, each offering a different level of risk and return. Finally, these tranches were sold to investors around the world as mortgage-backed securities, MBS, and collateralized debt obligations, CDOs. On paper, it looked brilliant. Risky loans were mixed with safer loans, supposedly balancing the danger. The lowest risk slices were labeled AAA, the same rating given to U.S. Treasury bonds. Pension funds, hedge funds, European banks, and even governments rushed to buy them. Why? Because they were promised high returns with almost zero risk. But this illusion depended entirely on one fragile assumption, that housing prices would never fall nationwide. If borrowers defaulted, the homes would still be valuable. If one region struggled, another would compensate. Wall Street convinced itself the system was unbreakable, but reality had other plans. Behind the scenes, the quality of the mortgages inside these securities was collapsing. Subprime loans, issued to borrowers with poor credit, low income, or unstable finances, were being pumped into these pools by the millions. The people creating MBS and CDOs didn't care. The ratings agencies didn't look closely, and the investment banks selling them knew exactly how to market the illusion of safety. Securitization created an unstoppable feedback loop. The more investors demanded mortgage securities, the more banks needed new mortgages to feed the machine. And the more mortgages banks issued, the more toxic loans entered the system. Wall Street was making billions in fees. Loan originators were earning record commissions. Everyone was winning, except the borrowers trapped in loans they could never repay. Even worse, some financial institutions began creating synthetic CDOs, securities that didn't even contain real mortgages, but were simply bets on the performance of other mortgage securities. It was speculation stacked on speculation, a tower of risk built on a foundation of sand. By 2006, the entire structure had become a global house of cards worth trillions of dollars. Investors believed they were buying gold, but what they actually held were time bombs. All it would take was a rise in mortgage defaults, even a small one, to unleash chaos. And that moment was rapidly approaching. Securitization didn't just spread risk. It multiplied it. It disguised it. It exported it across the entire world. What started as a clever financial innovation became the engine of the worst economic collapse since the Great Depression, and no one realized how fragile the system was until it was already breaking apart. By 2006, the cracks in America's housing miracle were no longer small fractures. They were widening into deep, unmistakable fault lines. For years, the system had been propped up by cheap credit, blind optimism, and the belief that rising home prices could fix anything. But math has no mercy, and it was mathematics, not politics, not sentiment, that finally brought the illusion to its breaking point. At the core of the unraveling was a single, deadly feature of many subprime mortgages: adjustable rates. These loans were designed with deceptively low initial payments that would reset to much higher levels after 2 or 3 years. Borrowers who had been told they could always refinance later suddenly faced monthly payments that doubled or even tripled overnight. For millions of families, the promise of homeownership turned instantly into financial suffocation. The first wave of failures hit subprime borrowers, the very people lenders had aggressively targeted with misleading promises and predatory contracts. These borrowers had never been able to handle the new payment levels. When their mortgages reset, they simply collapsed. Foreclosures surged. Neighborhoods that once symbolized the American dream began to show signs of distress. Overgrown lawns, abandoned houses, bank-owned signs on every block. But the crisis didn't stop there. The second wave hit middle-class homeowners who had used their properties like ATMs during the boom. They had refinanced repeatedly, taking out cash as homes appreciated. When prices stopped rising, they were trapped with massive debts they couldn't pay back. Suddenly, even borrowers with decent credit found themselves underwater, owing far more on their homes than the homes were worth. As defaults increased, something even more dangerous was happening behind the scenes. The value of mortgage-backed securities began to collapse. Investors who had been promised safe, AAA-rated assets discovered that their holdings were filled with failing loans. Hedge funds began to liquidate. Banks quietly wrote down billions in losses. Panic, once unthinkable, began spreading. By 2007, the financial system was tightening. Credit dried up. Banks stopped trusting each other. The once booming housing market froze as buyers retreated and sellers slashed prices in desperation. Homes that had taken days to sell during the boom now sat unsold for months. Every month brought new waves of foreclosures, pushing home prices even lower. And every decline in price triggered more defaults, because millions of mortgages had been structured around rising values. The system entered a brutal feedback loop. Defaults caused price declines, and price declines caused more defaults. Economists call it a downward spiral. Families called it disaster. Millions of Americans watched their life savings evaporate. Retirement accounts shrank. College funds disappeared. Entire communities fell into decline. And for the first time, the country realized that this crisis was not temporary, not isolated, and not fixable through optimism. It was structural, it was systemic, and it was accelerating. By the end of 2007, the writing was on the wall. The belief that no one loses in housing had been shattered. The people who had been promised prosperity were now losing their homes. The investors who had been promised safety were now losing billions. And the institutions that had built their empires on mortgage profits were now trembling. The breaking point had arrived, and what came next would shake the entire global economy to its core. By 2006, the cracks in America's housing miracle were no longer small fractures. They were widening into deep, unmistakable fault lines. For years, the system had been propped up by cheap credit, blind optimism, and the belief that rising home prices could fix anything. But math has no mercy, and it was mathematics, not politics, not sentiment, that finally brought the illusion to its breaking point. At the core of the unraveling was a single, deadly feature of many subprime mortgages: adjustable rates. These loans were designed with deceptively low initial payments that would reset to much higher levels after 2 or 3 years. Borrowers who had been told they could always refinance later suddenly faced monthly payments that doubled or even tripled overnight. For millions of families, the promise of homeownership turned instantly into financial suffocation. The first wave of failures hit subprime borrowers, the very people lenders had aggressively targeted with misleading promises and predatory contracts. These borrowers had never been able to handle the new payment levels. When their mortgages reset, they simply collapsed. Foreclosures surged. Neighborhoods that once symbolized the American dream began to show signs of distress. Overgrown lawns, abandoned houses, bank-owned signs on every block. But the crisis didn't stop there. The second wave hit middle-class homeowners who had used their properties like ATMs during the boom. They had refinanced repeatedly, taking out cash as homes appreciated. When prices stopped rising, they were trapped with massive debts they couldn't pay back. Suddenly, even borrowers with decent credit found themselves underwater, owing far more on their homes than the homes were worth. As defaults increased, something even more dangerous was happening behind the scenes. The value of mortgage-backed securities began to collapse. Investors who had been promised safe, AAA-rated assets discovered that their holdings were filled with failing loans. Hedge funds began to liquidate. Banks quietly wrote down billions in losses. Panic, once unthinkable, began spreading. By 2007, the financial system was tightening. Credit dried up. Banks stopped trusting each other. The once booming housing market froze as buyers retreated and sellers slashed prices in desperation. Homes that had taken days to sell during the boom now sat unsold for months. Every month brought new waves of foreclosures, pushing home prices even lower. And every decline in price triggered more defaults, because millions of mortgages had been structured around rising values. The system entered a brutal feedback loop. Defaults caused price declines, and price declines caused more defaults. Economists call it a downward spiral. Families called it disaster. Millions of Americans watched their life savings evaporate. Retirement accounts shrank. College funds disappeared. Entire communities fell into decline. And for the first time, the country realized that this crisis was not temporary, not isolated, and not fixable through optimism. It was structural, it was systemic, and it was accelerating. By the end of 2007, the writing was on the wall. The belief that no one loses in housing had been shattered. The people who had been promised prosperity were now losing their homes. The investors who had been promised safety were now losing billions. And the institutions that had built their empires on mortgage profits were now trembling. The breaking point had arrived, and what came next would shake the entire global economy to its core. By early 2008, the U.S. financial system resembled a skyscraper built on rotting foundations. From the outside, everything still looked stable. Banks reported confidence, politicians reassured the public, and Wall Street insisted the market would correct itself. But behind those polished statements was a reality too terrifying for the industry to admit. The mortgage machine that had fueled a decade of profits had mutated into a weapon of mass financial destruction. The first major casualty was Bear Stearns, one of America's oldest and most respected investment banks. For years, Bear had aggressively invested in mortgage-backed securities and complex derivatives tied to the housing market. When subprime borrowers began defaulting, the value of these assets plunged. 2 of Bear Stearns' hedge funds collapsed, sending shockwaves through the financial world. Rumors spread that Bear was insolvent. In finance, rumors are lethal. Within days, confidence evaporated. Trading partners pulled their money. Credit lines were frozen. Bear Stearns found itself unable to fund daily operations. Its collapse seemed imminent, a historic event that could trigger global panic. To prevent disaster, the U.S. government orchestrated an emergency deal. In a stunning weekend negotiation, J.P. Morgan Chase bought Bear Stearns for a price so low it shocked the world. A firm once valued at $20 billion was sold for just $236 million. Practically nothing. Wall Street was shaken, but many hoped the crisis had peaked. They were wrong. The next giant to fall was even bigger: Lehman Brothers, a powerhouse with over 150 years of history. Lehman was deeply exposed to toxic mortgage securities and had borrowed enormous amounts of money to amplify profits. When the housing market collapsed, Lehman's balance sheet disintegrated. For months, Lehman executives insisted they were strong, but investors saw the truth. The firm was drowning in bad debt. Stockholders fled. Creditors panicked. Lehman's liquidity evaporated. By September 2008, the situation became impossible to hide. In a desperate attempt to save the bank, Lehman tried to find a buyer. Talks with potential rescuers failed. Unlike Bear Stearns, there would be no government bailout. The U.S. Treasury and the Federal Reserve, fearing the political consequences, refused to intervene. And so, on September 15, 2008, Lehman Brothers filed for bankruptcy, the largest corporate failure in U.S. history. The impact was instantaneous and catastrophic. Global markets collapsed. Banks stopped lending to each other. Stock exchanges around the world plunged into chaos. Institutions that relied on Lehman to clear transactions suddenly found themselves holding worthless contracts. Money market funds broke the buck for the first time in history. Credit markets froze completely. Companies that had nothing to do with mortgages suddenly couldn't finance payrolls. Entire industries trembled on the verge of collapse. It wasn't just a banking failure. It was a systemic meltdown. And it didn't stop with Lehman. AIG required a massive government rescue. Merrill Lynch sold itself to avoid collapse. Washington Mutual became the largest bank failure in U.S. history. The giants fell one after another, like dominoes in a chain reaction triggered by years of greed, denial, and reckless risk-taking. The illusion of stability that had kept the system afloat for so long finally shattered, revealing a financial architecture so fragile that a downturn in the housing market destroyed the global economy. By the end of 2008, millions had lost jobs, homes, retirement savings, and trust in the institutions meant to protect them. The world had witnessed the most devastating financial collapse since 1929, and it all started with mortgages that were never supposed to fail. By the time the dust settled in late 2008, millions of people were left asking the same question. How could this happen? How could the world's most advanced financial system collapse so spectacularly, so violently, and so quickly? The truth is far more unsettling than any single mistake or bad decision. The crisis wasn't an accident. It was the inevitable result of a system built on structural flaws, misaligned incentives, and an economic philosophy that rewarded risk-taking over responsibility. To understand why the collapse was unavoidable, you have to look at the architecture of the American financial model itself. For decades, the U.S. economy had been driven by consumption, spending, borrowing, and investing at ever-increasing levels. Growth wasn't powered by rising wages or productivity. It was fueled by debt. And nowhere was debt more aggressively promoted than in housing. The government encouraged homeownership as a national ideal. Banks pushed mortgages as tools of wealth building. Wall Street demanded more loans to feed its securitization machine. Every major institution, public and private, depended on the constant expansion of credit. The system didn't just tolerate risk, it required it. But the real flaw, the fatal flaw, lay in the way incentives were structured. Mortgage brokers earned commissions for issuing loans, not for issuing good loans. Banks profited from the volume of mortgages sold, not the quality. Rating agencies were paid by the banks whose products they rated, creating a conflict of interest that led to toxic assets being stamped AAA. Investors, hungry for returns in a low-rate environment, ignored warning signs in pursuit of yield. In such an environment, reckless behavior wasn't an anomaly, it was a rational response. Another built-in flaw was the belief that financial markets were fundamentally self-correcting. For decades, deregulation had been the dominant ideology. Policymakers assumed that Wall Street would control its own risks because it was in its best interest to do so. But when short-term profits are enormous and long-term risks are invisible, the incentive to self-regulate disappears. The market wasn't self-correcting. It was self-destructive. And then came the final ingredient, the illusion of perpetual growth. The entire housing ecosystem, lenders, builders, investors, and homeowners, depended on one assumption: home prices will never fall nationwide. That belief permeated every financial model, every investment, every government policy. But it was mathematically impossible. No asset can rise forever, especially not faster than income, inflation, and population growth. The U.S. housing market was a bubble long before anyone admitted it. And because the bubble was tied to the global financial system through securitization, its collapse was not just inevitable, it was catastrophic. Once home prices stopped rising, the entire chain snapped. Borrowers defaulted. Securities collapsed. Banks panicked. Credit markets froze. The interlocking structure of debt, leverage, and speculation crumbled like a house of cards, revealing that the system had been fragile from the start. The crisis wasn't caused by one bad decision or one corrupt institution. It was the product of a model that rewarded greed, ignored risk, and depended on endless expansion. A model that transformed housing, a basic human need, into a financial commodity traded like poker chips across the world. And because the flaw was structural, not accidental, the crisis was never just possible. It was inevitable. The 2008 collapse didn't just expose weaknesses in the American housing market. It revealed the dangers of an economy built on debt, speculation, and the belief that markets can defy gravity. It was a warning to the world that when an entire system depends on illusions, the moment reality catches up, everything falls apart.